Now, among the various things that have changed over the course of the last 2 years, one thing in particular I think will stand out, and that is the way that you order stuff to consume. I'm talking about groceries, I'm talking about vegetables. A lot of you will be ordering in on applications that are on your mobile phone. And before I get to that, I have a question for you. What were you doing when you were 20 years old? If I think about that question, I know that I wasn't the chief executive officer of a company. Joining me now on this very special chat is the chief executive officer of Zepto. Adit, thank you so much for taking the time.
Thanks for having me. It's a pleasure.
We are walking in your office
Please.
in Mumbai.
Yeah.
And I want to start by asking what the inception of this is, because you joined this hyper-local space, which is really booming.
Yeah.
I think you were one of the last to enter. What was the thinking behind it?
Look, I think the space of delivering groceries incredibly quickly, when we started, Kevalia and I, there was really no one that was, diving deep into that specific problem statement. And for us, when we were starting up the company, we didn't really have like a large macro viewpoint of, what the industry was, what's the large scale, trends that we're hooking ourselves to. What we were more focused on was, hey, we've got 100 customers around us that have this serious pain point of getting their groceries. And if those 100 customers were not happy, we felt that there was an opportunity there to solve that problem for them. And so once we built something that solved the need for the first 10, 50, 100 customers, that's when we said, okay, this could be interesting. So the thought process was never, let's start a business, what's the large macro trend behind it? It was just, hey, there are people around us that are not getting what they need out of their grocery buying experience. Can we solve for that? And if so, that's something that could scale into being an exciting product.
So I'm curious, because this hyperlocal delivery space, I think a lot of people are speaking about it. Some people are saying that it's not going to work. Some people are saying that it's a huge opportunity. I don't think there's any clear data as to how quickly it has grown and how big it is.
Yeah.
How big is it for you? How quickly have you grown?
Look, I mean, we launched in July of 2021. Actually, you see these little snippets above us, right? You can see these Zepto turns one around us is because a couple of months ago we turned 1 year old, right? So it's been 15, 16 months or so. And we've effectively gone from, zero to thousands of crores in annual sales within the span of the first 15, 16 months of existence. That made us, not to sound bombastic, right? But if I, give some credit to the team, it made us one of the fastest growing companies of all time in India. And yeah, I'm feeling pretty good about that.
Okay, so we've established how quickly you've been growing. But I'm actually curious about, and you said that the inception was to solve a problem, a very specific problem. You've grown spectacularly from there. I want my viewers to understand how this works though. So do you essentially collect the stuff that is available on your platform, then deliver? Because there's a time element involved.
Yeah, no, I'll explain it. It's a great question. So what we do is, and what most people in our industry do, we've got pickup points and facilities across the country that we tie up with and work with that are dedicated for delivery. And that's essentially how we're able to reach customers in short periods of time, because we don't have, let's say, large scale facilities on the outskirts of a city like traditional e-commerce. We tie up with facilities that are close to dense population clusters within a city. So today, if you're in Mumbai and you're living in Bandra, there'll be one of a delivery hub or a partner facility close to you that we can actually use.
So there's a radius that it serves?
Correct. And within, within the whole process of delivering an order, there's a huge amount of innovation, both on the operational side and the technical side, that's gone into getting this done. Right? For example, on the technical side, we've built out processes that have helped us navigate, the people that are packing your orders through the most ideal route that they have, right? So if there's a path that you need to follow to pick up all the items in your order, that's highly optimized. Or, how can we predict beforehand what we expect customers to buy and have that oriented towards, an
So you're
exit,
stocking
right?
essentially to a certain extent.
And planning our processes to get the entire process of picking, bagging, and dispatching groceries down to 60 to 90 seconds.
Wow.
Right? So from the time that you click the checkout button, the time that the groceries are packed and sent out, 60 to 90 seconds.
I will come back to the time element because I think that is something a lot of people are focusing on.
Yeah.
But before we do that, I want to understand scaling.
Yeah.
Because I would assume this would be a factor of two aspects. One is the number of touch points.
Sure.
And also the number of riders that you have.
Sure.
So how is that growing and what is the trajectory you see? Where does it stand right now?
Look, that's a good question. I think basically today we've got tens of thousands of weekly active delivery drivers that work with us. We help them find employment opportunities that we believe are not only not only difficult to find, but also better than traditional delivery options.
Sure.
And I can talk about that in more detail. But more importantly, I think on the overarching supply chain that we've built out, right? That's something that, although the company is scaling from a customer perspective, we're not trying to scale the existing supply chain too aggressively.
Okay.
The reason why is because we want to drive more utilization and throughput through the existing supply chain that we have. So for example, if the business is growing, hypothetical number, 3x every year,
Sure.
our base of supply chains on the back end or the facilities that we're working with are probably growing 1.5x every year or
Okay.
1.7x every year,
Okay.
and there's better utilization getting driven through
I
that.
read that your expense as a percentage of
Sales
is significantly lower than it was
Yeah,
earlier.
absolutely.
This is effectively why?
It's effectively why. I mean, I think if you look at any supply chain intensive business, right, as you're scaling, there will be fixed costs and fixed investments that you need to make in the early days. And so as we've achieved scale, we've seen not only significantly better unit economics, but significantly better reliability on how many new delivery drivers do we need, how many new spokes do we need in the supply chain. So it's a lot clearer now. I think before last year we were growing almost doubling every month.
Sure.
And
In
so
terms
that-
of capacity.
Exactly. And so at that point, there's a huge amount of fixed investments that have come in. But now that throughput is starting to hit the entire supply chain, it's a lot more efficient.
Is the touch point the biggest cost in the expense chain?
It's a good question. I think the delivery front is the biggest expense, right? So your
Okay.
actual last mile
Right.
is the biggest chunk as a percentage of revenue in terms of cost.
I want to go back to the time question because I think some people have called it a gimmick.
Sure.
Aadit, the 10-minute delivery,
Yeah.
at some point will people say, okay, this is not possible to do in every situation? Does that then zoom out and say, we'll do it in 20 minutes?
Yeah. No, that's a good question. So look, I think as a company, Zepto, we're doubling down on fast delivery.
Okay.
Right? And specifically 10 minutes, we're working every day to hold and maintain that. That's part of the ethos. And the reason why we're looking at it is two reasons, right? One is, we're very data driven. We look at the data for customers that are getting deliveries done in 10 minutes versus 30 minutes. And what you'll find is that there isn't a difference between the number of customers that stick around. The same number of customers stick around whether they're doing 10 minutes or 30-minute delivery. But the difference is frequency.
Okay.
And so if you've got a customer that's getting deliveries in 10 minutes, he will order more on your platform, give you more revenue than a customer that's not getting deliveries done in 10 minutes.
Okay.
Right? And so when you increase delivery time, you give people a better opportunity to transact more frequently. Like you get significantly better frequency.
Right.
And we've seen, our net promoter score and like the overall revenue retention that we look at in aggregate improve with that. So on the customer side, and frankly, there are we have millions of customers on the platform. When we look at making decisions, we compare between, let's say, the pretty sophisticated data points that we have access to today versus the 200 character philosophy on Twitter. Right? We prefer the former.
Okay.
But I'll talk through on the cost
Sure.
side as well, right? And I think this is there has been something that I've been trying to push out on cost, which is I believe, looking at the numbers, that the faster we deliver doesn't necessarily mean that the expenses go
Cost,
up.
yeah.
Right? Because actually, if you look at it principally, we get deliveries done through short distances, not fast speeds. And so when you keep distances short, you can actually do more throughput per rider compared to longer, slower deliveries.
Sure.
So for example, if I'm paying a delivery driver 80 rupees per hour, and he's doing one delivery per hour with 6-7 kilometer distance, right? Then my cost for every delivery is 75 or 80 rupees. And if I'm paying him 75 rupees per hour.
Right.
But if I'm paying a delivery guy 75 rupees per hour and he's doing 2 deliveries per hour,
And the radius is smaller.
the radius is smaller. So it's instead of, let's say, 6 kilometers, it's 3 kilometers. So it's the same amount of distance for him. but he's now doing 2 deliveries per hour. That means the cost of every delivery is 37.5 rupees.
Right.
So the faster you end up delivering, the better it is. And the best thing about it is, if you're able to drive more efficiency, right, and you're able to do more per rider, you're actually able to pass on some of that efficiency to the delivery driver.
Right.
So he also gets more out of the transaction, right? And so if you look at our delivery driver retention today, it's 7% better than most hyperlocal delivery platforms. Because, we give delivery drivers, a better amount of the efficiency pie because we're able to drive, better leverage through them, right? And so, with shorter distances, do more deliveries, your costs come down. And because your costs are coming down, you can actually split that pie and say, I'm going to give delivery drivers an even better part of what they were usually getting.
Aadit, wouldn't you say that one part of that is going to be dependent on having those touch points? Because in order to have those shorter radiuses or smaller radiuses, you need more touch points. And that's going to be a costly proposition in the metro cities, right?
That's a 100% valid question. I think for us, what we look at is two things, right? So one is there's some pretty sophisticated network design that goes into each touch point or delivery hub that we work with, right? And so making sure that the delivery hubs are close to dense population clusters isn't as straightforward as it sounds. It requires a ton of depth on geographic centricity, road patterns, traffic data. We look at everything from real estate prices to delivery driver availability, multiple different factors that go into it. But if you are sophisticated in your approach to where to position or work with these delivery hubs, you'll end up optimizing the amount of hubs that you need to get the amount of coverage that you want within short distances. So that's number one. But the second one is, if you look at, let's say, how we look at the long-term orientation of the business model, right? We're seeing that, the hubs that we have, there's so much demand, even within an individual neighborhood, that we need to take more than one hub just to service one neighborhood.
Okay.
Right? And so, for example, if I've got, one hub in Andheri, very quickly, I'm out of capacity because the demand is so much higher.
Yes.
And so I need a second hub just within Andheri, same area, right?
And it is a large area also, and the number of people. Correct.
Even outside Andheri, right? Even smaller areas, you've seen exactly the same trend.
Sure.
And so we have essentially need to have more hubs to handle the demand anyway.
Fair enough.
And so the natural steady state hubs that we'll need to service the market or the market size that we're looking at for quick commerce will be significantly more than just like the geographical spacing. So the way to illustrate this is to say, okay, if I need to cover Bombay or Mumbai as a market, I need 50,
touch points.
50 delivery hubs or touch points. But if I want to service all the demand that I'm anticipating, I will need 100.
Okay.
So I'll anyway need, or I'll anyway end up with shorter distances.
So it's not just geographical spread.
Yeah, which is what, not just Zepto is seeing, but across the industry, I think it's a trend. So you end up with the cost structure that you're talking about, you will incur anyway, right? And so if you optimize your the delivery distance, you end up putting yourself in a position where you're actually optimizing the cost that matters. Because counterintuitively, fixed costs are not very significant for us because of the amount of throughput that we're able to drive per delivery.
Yeah, correct.
Correct. And so what you really want to be optimizing for is that last mile cost because that's much more chunky. So yeah.
I want to ask about the basket size.
Sure.
Correct me if I'm wrong. What I'm getting is that a more number of orders is better for you rather than size of the basket, obviously, right? So when you have a shorter delivery time, usually you would have smaller baskets. Is that the right?
I mean, that's actually not necessarily true, right? Like at least within 10 to 30 minutes, we haven't seen that delta, right? And so if you look at, let's say, the data that we haven't seen a significant difference in average order value between each. That being said, I think obviously if you do next day versus 10 minutes, then there's obviously a delta. But what we have seen is to drive average order value, it's, we are at a reasonably healthy average order value compared to hyperlocal delivery platforms. The thought process for us is not so much just average order value, but what's the mix of that? Because today, if I want a 1,000 rupee average order value, right, we will push our platform, we'll push customers on our platform a lot of oil, right? Lots of oil, very high pack sizes, 1,000 rupee, like for those large jugs of oil, right?
Yeah.
Very easy to sell them. But the problem is that the commission that we end up netting from that is barely a few percentage points. Versus if I pick up a high margin category like, let's say, fresh fruits and vegetables.
I was going to ask.
Exactly, right? And so if I do 300 rupee fresh fruits and vegetables order, it's actually better for me than the 1,000 rupee oil order.
What is the split right now, though, Aadit, in terms of vegetables and fruits? Because that, I think, is something a lot of people are interested in.
Yeah, it's a great question. I won't go into the specific
Nitty-gritties of it,
the
but
numbers.
if you give me a broad...
But yeah, but to give you a
idea.
sense, I think this industry as a whole is seeing significantly higher fresh products, not just fruits and vegetables, but fresh meat,
Sure.
fresh bread and bakery, and fresh fruits and vegetables, seeing a much higher penetration of that than traditional offline grocery has seen, right? And that I think is a function of the use case itself, right? Because you can't buy a month's worth of bananas
Yeah.
because they'll go bad.
Of course.
So it is a high frequency use case for any household. And that's the beauty of Zepto, right? And if you're able to cater to that use case, which is not only making it a good customer experience, but if you're able to build a supply chain efficiently enough, you'll be able to service that use case profitably. And so that's the objective, right? So we look at, sort of, to come back to your question on average order value, right?
Yeah.
We are more concerned about what's actually happening under the hood there than just the headline number of average order value when you double click and triple click. But more importantly, the thesis is always, how do customers want to buy? Real everyday customers, how do they want to buy? What's their behavior? If this is their behavior, that they don't want to do 1,000 rupee baskets, they'd much rather do 300, 400 rupee baskets with a little less friction. If that's your behavior, how do we build our supply chain efficiently enough to service that profitably? That's the thought process.
But I'm still curious, Aadit. I mean, don't necessarily tell me what Zepto is doing, but if you have
Sure.
an idea about consumption patterns for fresh
Sure.
groceries, are people buying more stuff on quick delivery,
Yeah.
grocery, than they are buying other stuff? You know what I'm
as
saying?
in- yeah. No,
Like
I think
packaged
it's a-
food or
Yeah, I mean, there are multiple different categories.
Sure.
Right? There's packaged foods,
oil,
there's
like you mentioned.
oil, there's general merchandise, so
Sure.
like everything from cloths to basic cutlery to let's
But
say
what's the
plastic
split
glasses.
like?
Yeah, I have the split. This is a little bit difficult to give the absolute numbers for.
No, I don't want
nice
absolute
audience.
numbers. I want a sense.
Yeah,
In that basket, what is the kind of how do you populate that basket?
Yeah, so I think I would say you've got an equally sized sort of you've got an equally sized business on like your packaged foods,
Sure.
right, and your dals and attas and chawals.
Sure.
To let's say the bread, meat, fruits, vegetables, etc.
Even split.
So it's a roughly even split, and then after that you've got a lot more categories that are not like your traditional grocery buying, and are not your fresh products, like let's say home needs, right, like cutlery or glasses, or let's say your chips, drinks, chewing gums, those sorts of items. That ends up covering the gap, the remainder. But you've got pretty chunky, I wouldn't say evenly split, a little bit more skewed towards packaged foods, but the percentage, regardless of fresh products, is much higher than offline. So still packaged foods is still a bigger, but it ends up being, like as a percentage, a much bigger benchmark than what most offline grocers are used to.
I want to come to what is probably the last leg of this conversation, which is where you're heading from now.
Sure.
I think we've established over the course of this conversation that there's a huge amount of potential, right?
Yeah.
But are you going to focus on the markets where you're in right now and deepen your penetration and your reach, and then go further into tier 2 or beyond?
Yeah, absolutely. So I think the thought process is we want to continue to go deep into the markets that we're in, but we're absolutely scoping out new markets. And what we're seeing is the early signs of success that are pretty exciting. And so we will definitely, over the next couple of quarters, start launching a couple more areas, hopefully assuming a couple of things go well. But at this trajectory, we're hopeful that we'll continue to expand.
I'm actually curious because your rental costs in the smaller markets would be significantly lower.
Yeah.
And so for your unit economics might actually be significantly better.
You're 100% right. And so it's actually well balanced, right? Because if you have a tier 2 or tier 3 city, the propensity to pay might be a lot less, but your costs are even lower, right? And so you just end up with an equally solid model coming in. At least that's our thesis, looking at the signs of success that we're seeing right now. But the thesis that we have is that the economic model will be as rock solid as we're seeing today in tier 1 cities, as it will be in tier 2 and tier 3 cities. And I think generally there's a bit of a misconception that customers sitting in Surat or Indore or Ahmedabad or just general smaller cities in India have a very different preference or need less service than customers sitting in Mumbai and Bangalore. I think that's a misconception that we're realizing doesn't hold up when you look at the data.
Adit, the last aspect, and I say last aspect because I think at some point people are going to ask about financials.
Sure.
They're going to ask about making money.
Sure.
I know a lot of people in these industries think that, okay, that's something we'll do in the future.
Sure.
And therefore, what funds your growth?
Sure.
Is it internal accruals, or do you anticipate that you will have to raise funds? How does it work for Zepto?
So look, I think we're in a position where we're seeing some really healthy trends in the mature markets that we've launched. So the business is 15, 16 months old.
Sure.
But when I look at the mature markets that we've launched, they're actually starting to generate cash.
Okay.
And so we're feeling pretty good about where the end state trends are looking. And our investors are feeling very good about it as well, because frankly, the trends that we're seeing are even better than not just consumer internet, but even potentially offline grocery as well, right? In terms of where the mature stack of markets ends up, and extrapolating from there in terms of where the overall business will end up once you give it time to mature. And so profitability for us, I'm fairly confident, is not a function of hey, what needs to be, what needs to change to get this done. It's more so a function of
Scale.
maturity, not skill.
No?
Scale is also is subjective, right? It matters, market by market. If I got scale in a market, I'll be able to turn it profitable. What we're seeing right now is essentially, today, if we stop launching new markets, within 2-3 years, we would start generating cash, because that's what we're seeing with our mature markets. So today, the oldest markets that are 15 months old, 14 months old, are in that position. If I gave all the new markets equal amount of time, they will also get there.
Okay.
Right? But the reason why we obviously lose money, right, is because today we're launching significantly more new markets. And when I launch a new market, it starts at a very negative contribution margin.
Right.
And then over time scales into a positive one. So people ask me, hey, when do you plan to get profitable at an overall level as a company? I'm saying, my response to that usually is, it's a function of how many new markets we want to launch, right? And so if we stop launching markets tomorrow, I can give you a very exact statement. This is how much time it will take us to get profitable. But I don't anticipate that. And I anticipate us launching markets for the foreseeable future. But the healthy trend is, as we've started turning mature markets profitable, we're actually seeing the cash being generated from them funding the new markets that we're launching.
Interesting.
That's still very much in its early stages, to be transparent. But that's what's starting to take a hold of the business, and that's what's starting to take a hold of the management team. That let's start using the cash that we're generating from our mature markets to start investing into new markets and create that flywheel. That's what most healthy businesses do. And then in the meantime, to build a balance sheet and to fund any additional spends that you have, that's when you raise capital.
Do you need to?
Look, I think we're in a position where we've raised 200 million very recently.
Sure.
Right?
And $900 million valuation.
Sure. And for us, we're actually pretty well indexed, I feel.
Okay.
On capital efficiency and on our unit economics, right? And when we talk to our investors who happen to be, because I'm quite lucky, we've got some pretty solid investors on board as well. But we're sitting in a position where our unit economics are solid, our capital efficiency is solid. We're really not spending as much money as even we would have expected, given sort of the metrics that we're operating at. And so with the cash that we have, we're in a pretty healthy position for quite some time. So no absolute need to raise capital in the short or medium term, right?
I completely forgot that I needed to ask you this question, not about business. Aadit, I started this conversation by talking about the fact that you're 20 years old, you're a chief executive officer.
Yeah.
I know when I was 20 years old, I was far from that. I'm not a chief executive officer today. What do you do for fun, man?
Yeah, I mean...
do you have the time?
I do, right? I have, as the business has scaled, there has been a little bit more of a necessity to not do something that's related to work. But honestly, I don't have very interesting answers for you, right? I love watching documentaries.
Okay.
I'm addicted to documentaries in a way. There's a couple of Netflix for documentary subscriptions that I have that I should not name here because it'll make me look even less interesting. But I love documentaries. I love cycling and basketball.
Okay.
And yeah, I mean that's what I usually do for fun. And then other than that, Kevalia and I, we're founders, but we also have a really good relationship, and
Sure.
so we
You were
spent
classmates.
time- we were classmates, and so we spent a good amount of time just playing basketball or playing cards, whatever. But yeah,
Awesome.
That's what we do on weekends sometimes.
Okay, so it's been a fun conversation.
Yeah.
Thank you so much for taking the time.
I appreciate it. It was great being here.
Yeah.
Thanks a lot.
Stay tuned to BQ Prime.